Most people hear the phrase $1 million real estate portfolio. They instantly imagine someone who inherited money, got lucky, or had connections that opened doors the average person could never dream of. Investment. Everything makes a good investment, but that's not how my story went. I wasn't born into wealth. I didn't win the lottery, and I definitely didn't have a magic shortcut. What I did have was a vision, a willingness to start small, and an obsession with learning every detail about the real estate market that I possibly could. I remember being in my early 20s, watching friends take on student loans, car payments, and expensive lifestyles while I was working extra jobs, saving every penny, and renting a modest place just so I could stash away enough money for my first property. It wasn't glamorous, and it definitely wasn't easy. In fact, investment. There were moments when I questioned whether it was worth all the sacrifice. But the turning point came when I realized that real estate wasn't just about owning property. It was about building leverage, investment, creating cash flow, and positioning myself for long-term wealth. The idea of building a portfolio worth $1 million by the age of 30 sounded almost impossible when I first started. Investment. But here's what made it possible. I treated every dollar like it had a purpose. I treated every property like a stepping stone, and I never let short-term temptations distract me from long-term goals. While others were focused on vacations, new cars, or expensive nights out, I was focused on running the numbers, making offers, and learning how to scale. The journey was filled with mistakes. I overpaid for repairs on one property. I underestimated tenant issues on another. And I can't even count how many offers were rejected before I finally landed a deal that made sense. But here's the truth. Every mistake became a lesson, and every lesson pushed me closer to my goal. The beauty of real estate is that once you understand the fundamentals, it becomes a repeatable process. Investment. The first property feels like climbing a mountain. The second feels like a challenge. But by the third and fourth, you start to realize you've built a system that works. And that's what I want to share today. Not a fairy tale version of real estate investing where everything goes perfectly, but the real roadmap, the exact mindset, habits, investment, and strategies that allowed me to go from nothing thing to $1 million portfolio before hitting 30. Because if there's one thing I've learned, it's that success in real estate isn't reserved for the wealthy. Investment. It's reserved for the persistent, the disciplined, and the ones willing to think long term when everyone else is distracted by the short term. So if you're sitting here wondering if real estate is possible for you, everything makes a good investment. Let me be clear, it absolutely is. The path is challenging, but it's straightforward. And if you can stick with it, you'll discover what I did, that real estate isn't just about money. It's about freedom, investment, options, and the ability to design a life on your terms. Now let's break down the 4 key principles that made all of this possible. When it comes to building wealth through real estate, one of the most powerful principles I followed was starting small, but starting early. Too many people wait until the so-called perfect time to get into the market. They believe they need a massive down payment, investment, a dream property, or years of experience before taking the first step. But the truth is, there is no perfect time. Waiting for the stars to align usually means never getting started at all. That's why I committed to buying my first property as soon as I possibly could, even if it wasn't impressive on paper. It wasn't about buying the perfect property. It was about buying my first property. That decision became the catalyst for everything that followed. My first property was modest. It wasn't in a fancy neighborhood, and it didn't have all the bells and whistles people dream about when they think of investing in real estate. But it did one thing perfectly. It got me into the game. I learned the process of applying for financing, investment, negotiating a purchase price, handling inspections, and closing a deal. Those lessons are things no book, seminar, or YouTube video could have fully taught me. By starting small, I gave myself the ability to make mistakes on a scale I could handle. And trust me, there were mistakes, but each one made me better prepared for the next deal. Another advantage of starting early is the power of time. Of investment, real estate rewards patience. The earlier you begin, the more time you give your property to appreciate in value, the more time you have to pay down the mortgage, and the more years you allow rental income to work in your favor. I bought my first property in my 20s, and while the cash flow wasn't life-changing at the time, fast forward a few years and the equity growth combined with rental income became the foundation that allowed me to scale. If I had waited until I felt completely comfortable, I would have lost those years of growth. Starting small also taught me discipline. When you don't have unlimited resources, you learn to stretch every dollar and think creatively. I had to be careful with repairs, cautious with tenant selection, and diligent about managing my expenses. Those habits carried forward into larger deals. By beginning with a smaller property, I wasn't overwhelmed financially. Everything managed the learning curve without the pressure of huge monthly payments or complicated projects. This manageable entry point built my confidence, and with confidence came momentum. Momentum is often overlooked, but it's critical. Your first deal builds momentum, and momentum builds belief. Once you've bought one property, suddenly buying a second doesn't feel as intimidating. That snowball effect is real. My first deal gave me the knowledge, the credibility, and the motivation to go after the next one. And because I started early, I was still young enough to make adjustments, recover from mistakes, and take advantage of opportunities that came my way. There's also a psychological benefit to starting early, even if it's small. Every time you see a rent check come in or your mortgage balance go down, you start to think differently about money. You stop thinking in terms of just saving and spending, and you begin thinking in terms of assets and cash flow. That shift in mindset is powerful. Most people my age at the time were focused on jobs and paychecks. Investment. I was focused on creating streams of income that didn't rely on me trading hours for dollars. That mental shift, more than anything, kept me motivated through the difficult times. Of course, starting early doesn't mean rushing blindly into the market. It's not about buying the first property you see just to say you own one. It's about finding a deal that works within your budget and fits your long-term goals, even if it's modest. My first property wasn't glamorous, but the numbers made sense. It produced positive cash flow, even if it was small, and I knew it would be a stepping stone. That's the key. You don't need to swing for the fences on your first deal. You just need to get on base. Looking back, starting small and early wasn't just a strategy. It was the foundation of everything. Without that first property, I wouldn't have built the experience, confidence, and equity that fueled the rest of my portfolio. Too many people paralyze themselves waiting for the perfect time or the perfect deal, but real estate is about action. The sooner you act, the sooner you learn, and the sooner your assets begin working for you. So everything makes a good investment. If you're wondering whether you should wait or whether you should start now, let my experience be a reminder. Start now. Start small, but just start. Because in real estate, time and action are your best allies. Makes a good investment. And the earlier you use them, the more powerful they become. When I first started in real estate, I thought success would come down to finding the right property in the right location. And while location is important, I think makes a good investment. I quickly realized that the true foundation of real estate wealth isn't about falling in love with a property. It's about falling in love with the numbers. Properties can look appealing. Neighborhoods can seem promising, and agents can sell you on the idea of future growth, but none of that matters if the math doesn't work. Mastering the numbers became the single most important skill I developed. And it's what kept me from making mistakes that could have cost me years of progress. The truth is, emotions can be dangerous in real estate. It's easy to get excited when you walk into a nice house with fresh paint, a stylish kitchen, or curb appeal that makes you think, I could live here. But the question isn't whether I could live there. It's whether the property will produce consistent cash flow, cover expenses, investment, and provide a reasonable return on investment. That's where numbers come in. By treating every property as a business, I stopped looking at houses as homes and started seeing them as financial tools. That shift was critical. The first numbers I mastered were the basics, income, and expenses. On the income side, it meant accurately projecting rental income, not what I hoped it would be. I researched comparable rents in the area, verified vacancy rates, and stayed conservative in my estimates. On the expense side, I accounted for everything: mortgage payments, property taxes, insurance, utilities, investment, repairs, management fees, and most importantly, reserves for unexpected costs. Many beginners forget to set aside money for repairs or vacancies, and that's how they end up struggling. Investment. I treated these hidden costs as non-negotiable, and that discipline protected me from unpleasant surprises. Cash flow analysis became my compass. If the projected rent minus all expenses left me with positive cash flow, investment. The deal was worth pursuing. If not, I walked away, no matter how beautiful the property looked or how badly I wanted to close a deal. This discipline saved me countless times. and passed on properties that looked great at first glance but didn't make financial sense. Later, I saw some of those properties become burdens for the people who bought them. Investment. That reinforced my belief that the numbers never lie. Another key metric I studied was the return on investment. I wanted to know how hard my money was working for me. Investment. A property that produced a small cash flow might still be a good deal if it offered strong appreciation potential or significant tax advantages. But if the return wasn't competitive compared to other opportunities, I moved on. This mindset kept me from settling for average deals and pushed me to find ones that truly accelerated my portfolio growth. Financing was another area where numbers played a critical role. I didn't just accept the first loan a bank offered. I compared interest rates, terms, and fees to make sure the financing worked in my favor. A small difference in interest rates could mean thousands of dollars over the life of a loan. By mastering financing numbers, I learned how to structure deals that minimized my costs and maximized my returns. One of the most valuable lessons came from running worst-case scenarios. Before closing on a property, I would ask, what happens if the market slows? What if I have to lower rent? What if a major repair comes up? If the numbers still worked in those scenarios, I felt confident moving forward. Investment. This practice kept me from overextending myself and gave me peace of mind, knowing I had a margin of safety. Mastering the numbers also gave me an advantage when negotiating. Sellers often expect buyers to make emotional offers, but I came in with spreadsheets, calculations, and clear justifications for every dollar I offered. That confidence helped me stand firm during negotiations and avoid overpaying. In the long run, buying properties at the right numbers made scaling my portfolio possible. Over time, analyzing deals became second nature. Investment. I could look at a property listing, plug the numbers into my formulas, and know within minutes if it was worth pursuing. That efficiency allowed me to analyze dozens of deals quickly and only focus my energy on the ones that had real potential. While others wasted time chasing dream properties, I was stacking solid, reliable investments that steadily built my portfolio. In the end, mastering the numbers wasn't just about making good purchases. It was about creating a repeatable system. Once I understood how to evaluate deals, I could apply the same process again and again, scaling up without taking on unnecessary risks. That's how I went from one property to several, and eventually to a $1 million portfolio before 30. The bottom line is this: properties will come and go, markets will rise and fall, but numbers remain constant. If the numbers make sense, the property is worth it. If they don't, it doesn't matter how nice it looks, you walk away. By focusing on numbers over emotions, I built a portfolio that wasn't just impressive on paper, but strong, resilient, and capable of weathering challenges. Investment. That discipline with numbers became one of the most valuable habits of my entire journey. When I think about how my portfolio grew from one small property into a $1 million collection by the time I was 30, one concept stands out as absolutely essential: leverage. Leverage, when used responsibly, is the secret weapon of real estate. It's the ability to control a large asset with a relatively small amount of your own money. Everything makes a good investment. Unlike other investments, real estate allows you to borrow against the property itself, meaning you don't need to save up hundreds of thousands of dollars to get started. But here's the key. Leverage only works if you understand how to use it strategically and combine it with the discipline to reinvest consistently. Misuse leverage and it can bury you in debt. Use it wisely and it can accelerate your growth far beyond what you could achieve with savings alone. When I bought my first property, I didn't pay cash. I used a mortgage with a small down payment investment. I gained ownership of an asset worth many times more than what I had in the bank. That's the beauty of leverage. You get the benefit of appreciation, rental income, and tax advantages on the full value of the property, even though you only put in a fraction of the money. For example, a 5% increase in value on a $200,000 property is at $10,000. If I only invested $20,000 to buy that property, that appreciation alone represents a 50% return on my initial investment. That's the kind of power leverage gives you. But leverage is a double-edged sword. It magnifies gains, but it can also magnify losses. That's why I was careful not to overextend myself. I always made sure the rental income could comfortably cover the mortgage and expenses with room to spare. This cushion meant that even if I faced unexpected repairs or vacancies, I wouldn't be scrambling to cover payments. Responsible leverage is about using debt as a tool, not as a gamble. Investment. The goal isn't to stretch yourself as thin as possible, but to maximize growth while still protecting your downside. Once I had my first property running smoothly, I made a decision that shaped the rest of my journey. Everything makes a good investment. I reinvesting. Instead of treating the rental income as extra spending money, I funneled it back into savings for my next down payment investment. I resisted the urge to upgrade my lifestyle because I knew that every dollar I reinvested would multiply in the future. That discipline of reinvesting turned one property into two, then three, and eventually into a portfolio that reached $1 million in value before I hit 30. One of the biggest mistakes I see people make is stopping after their first win. They buy one property, enjoy the cash flow, investment, and start spending the income on cars, vacations, or lifestyle upgrades. That short-term thinking robs them of the chance to scale. I took the opposite approach. Meant every property I bought became a stepping stone to the next. The income built momentum, and that momentum fueled growth. It was like compounding interest, but on steroids, because I wasn't just reinvesting profits, I was leveraging them into bigger assets. Another powerful tool I used was the equity I built in each property. As tenants paid down my mortgages and property values increased, my equity grew. I didn't let that equity just sit there. I used it to secure financing for additional properties. By refinancing or using home equity lines of credit, I unlocked capital that allowed me to keep buying without waiting years to save. Again, this only worked because I was disciplined with my numbers and ensured that each deal stood strong on its own. Reinvesting also meant continuously improving my properties. I didn't ignore maintenance or let them deteriorate just to save money. I invested in upgrades that increased rental income and property value, which boosted my returns and gave me more leverage for future purchases. In this way, reinvestment wasn't only about acquiring new properties. It was about maximizing the potential of the ones I already owned. Looking back, the combination of leverage and reinvestment created a snowball effect. Each property wasn't just an isolated win. It was part of a larger system where every dollar worked toward growth. Leverage allowed me to scale faster than saving alone ever could, and reinvestment kept the momentum going without interruption. Together, they created a cycle: buy a property, let tenants pay down the loan, reinvest the income, build equity, leverage that equity, and buy the next property over and over again until the portfolio grew beyond what I once thought was possible. Of course, this strategy required patience and discipline. There were times when I could have taken the cash flow and treated myself. There were moments when I was tempted to relax after a big win. But I kept my eye on the long-term goal, knowing that reinvesting today would give me freedom tomorrow. That long-term mindset made every sacrifice worth it. By age 30, I didn't just own $1 million portfolio. I owned a system that could continue growing for the rest of my life. And that system was built on two simple principles: use leverage smartly and reinvest consistently. They're not flashy strategies, but they're powerful. They're what allowed me to turn small beginnings into a portfolio that changed my financial future forever. When I look back on the years it took to build $1 million real estate portfolio by age 30, ever the most overlooked but critical habits I followed was avoiding lifestyle creep. This principle is simple in theory, but extremely hard to practice in real life. Lifestyle creep is what happens when your income increases, and instead of reinvesting or saving, you start spending more, upgrading your car, moving into a bigger home, buying nicer clothes, or splurging on luxuries that once seemed out of reach. It feels good in the short term, but it quietly drains the very resources you need to build long-term wealth. Choosing to delay gratification, investment, to resist those upgrades and to keep my focus on the bigger picture was one of the toughest decisions I made, but it was also one of the most rewarding. When I bought my first property and started earning rental income, I'll be honest, the temptation was strong. Suddenly, I had extra money flowing in every month, and it felt like I could loosen up a little. Friends were spending on new cars, taking trips, investment, and enjoying the perks of their paychecks. I could have easily joined them. Instead, I doubled down on living frugally. I drove the same car, lived in the same modest place, and kept my expenses as low as possible. Every extra dollar went straight into savings or back into my investments. At times, it felt like I was missing out, but I reminded myself that I wasn't sacrificing. I was investing in my future self. The power of this approach became clear as the years passed. While others were upgrading their lifestyles, I was upgrading my portfolio. The money they spent on luxuries was gone forever, But the money I reinvested was generating income, paying down debt, and building equity. That's the difference between short-term gratification and long-term wealth. Every time I resisted the urge to spend investment, I gave myself more capital to leverage into another property, which in turn gave me more income and equity. It was a snowball effect, but one that only works if you stay disciplined. Avoiding lifestyle creep also gave me flexibility. Because my personal expenses stayed low, I never felt pressure to stretch my investments to cover an expensive lifestyle. This safety net meant I could take calculated risks without worrying that a single setback would wipe me out. I could handle vacancies, repairs, or market fluctuations because my financial foundation was solid. It meant too many people box themselves in by tying their income to their lifestyle. When things go wrong, they're stuck. By keeping my lifestyle simple, I gave myself the breathing room to grow without fear. Investment. Another lesson I learned was the importance of defining success on my own terms. It's easy to measure success by what you drive, where you live, or what you wear. But those are surface level symbols that don't build real wealth. For me, success was measured by freedom. Freedom to choose how I spent my time, freedom to take opportunities, and freedom to design my own future. Investment. That kind of success doesn't come from spending money. It comes from building assets. Every time I was tempted to indulge, I reminded myself of the bigger picture. I wasn't building a lifestyle for today. I was building financial independence for tomorrow. Of course, delaying gratification doesn't mean never enjoying life. I wasn't living in misery or denying myself completely. Investment. What it meant was being intentional with my choices. Instead of automatically upgrading because I asked myself, does this expense bring long-term value? Will it move me closer to my goals or pull me further away? That mindset allowed me to make smarter decisions and enjoy experiences when they truly mattered without letting them derail my progress. By the time I reached 30, investment, the impact of avoiding lifestyle creep was clear. While many of my peers had nicer cars and bigger houses, they were still tied to their jobs, dependent on their paychecks, and worried about debt. I, on the other hand, had a portfolio that generated income and continued to grow in value. I had options, whether to keep scaling, to take time off, or to pursue new ventures. That freedom was worth far more than any short-term luxury I could have bought along the way. The lesson here is simple: wealth isn't built by how much you earn, but by how much you keep and reinvest. Income gives you potential, but discipline turns that potential into reality. Avoiding lifestyle creep is about protecting that discipline, ensuring that every dollar you earn has a purpose. For me, that purpose was building a future of financial independence. In the end, thinking long-term and avoiding lifestyle creep wasn't just about money. It was about mindset. It required me to value future rewards over present temptations, to see beyond the immediate and focus on the possibilities ahead. That mindset shaped every decision I made and became the cornerstone of my success. And if there's one takeaway I can share, it's this: don't let lifestyle creep rob you of your potential. Stay focused, stay disciplined, and remember that the freedom you can achieve tomorrow is worth far more than the fleeting comforts of today.